Hi, welcome to my monthly Market Insights video. My name is Dan Timitich. I'm a managing principal and one of the portfolio managers at T2 Asset Management. This video is going to take a look at what happened in April and give you some of my thoughts going forward. If you have any specific questions or simply want a second opinion, please give me a call or send me an email and I'll be sure to follow up with you. Before we get started, short reminder, this video is for educational purposes only. Opinions expressed in this video are mine and do not reflect the opinions of other portfolio managers at T2 Asset Management. You should always consult with a financial advisor before making any investment decisions. Investments involve risk and are not guaranteed. Okay, let's get started here. If you watch some of my previous videos, you'll know that it's been a tumultuous start to the year, but it appears that things have settled down a bit. While the S&P index is still down about 1% for the year, April was positive with a small gain of about 0.25%. Now, for all of you retirees and pre-retirees, try to pay close attention. Chances are you have a larger allocation to bonds, and bonds continue to disappoint. The 10-year Treasury yield is up about 0.5% this year, and this has caused the aggregate bond index to lose nearly 2.5%. This index has an effective maturity of only about 3 years. You don't even know how bad it got for long-term Treasuries. Think about that for a minute. Any increase in rates will cause a disproportionate fall in the value of your bonds. You need to understand that so that you don't wake up one day wondering why you're losing money in your bond portfolio. So, moving on to the month, some positives, some negatives. Major stock market indexes were mostly up for the month, with small caps and international doing better. Bonds, on the other hand, added to their losses for the year and remain under pressure. Looking at sectors, the real story is the turnaround in energy. It was up nearly 10% for the month, but the downward spiral in staples continues. Staples have lost over 4% for the month and are down over 10% for the year. Looking here, we have the four major components that I look at to analyze the current environment and allocate clients' money: the economy, earnings, valuation, and markets. So let's see where we're at. First quarter GDP came in better than expected, and the Atlanta Fed released its initial estimate of 4.1% growth for the second quarter. The European central banks and the Federal Reserve left rates unchanged as expected, and it still remains relatively accommodative. On the consumer side, a lot of positives. Existing and new home sales are better than expected. Consumer confidence is strong, and we're seeing some good employment numbers and wage increases. All in all, I'm still positive on the economy. Let's take a look at earnings. At the time of this video, more than half of the S&P 500 companies have reported earnings. Of those, 80% reported positive earnings surprises and 75% reported positive sales surprises. Earnings have been great and are on track to grow at over 23%. If this happens, it'll be the highest level of growth since the third quarter of 2010. Definitely positive on earnings. Moving on to valuations. Stocks remain elevated based on the 12-month trailing reported earnings, but the forward PEs look more attractive, sitting at their 5-year average. I still think earnings will propel stocks higher as long as interest rates remain in this recent range. On the fixed income side, credit spreads are tight and tightened for the month, proving that there is still an appetite for credit, even if there isn't much for treasuries. Rates are moving higher, so we need to pay attention to see how this is going to affect other markets, and therefore I have to be kind of neutral on valuations. Finally, the markets look relatively good. The S&P 500 is still holding above its lows for the year, and volatility has come down. Geopolitical risk and trade war concerns have subsided, so I'm sure the markets are going to look for something else to worry about. But until we see the break below the February lows, we should be okay. The yield curve is flattening, so I need to be neutral here since a continued flattening could put pressure on the markets. Going forward, I still like stocks over bonds and have an overweight to international, technology, small and mid-cap stocks. In fixed income, I prefer short-duration bonds, high yield, and floating rate securities. The less interest rate sensitive, the better. I'm staying away from interest rate sensitive positions. Long-duration bonds have gotten hammered this year, and if interest rates continue to grind higher, they're going to continue to feel the pain. Utilities, REITs, and staples are all interest rate sensitive as well, so I'm staying away from them. I hope this video was helpful, and remember, you don't need to do this alone. Whether you're looking for an advisor or simply want a second opinion, please reach out. Thanks again for watching, and we'll see you next month.